Yeah, it's always good to be here. This is the first time I've been in this space, though, and it's really nice. Excellent space. We're going to talk about the U.S. outlook, but we'll cover the international scene. One of the things that's interesting for me this year, I come at markets from an economist, but also from an investor point of view, and the disconnect between economics and markets seems especially large this year, and it's already started to show up. So we're going to talk about the economics first, and then we'll talk about the disconnect with the markets that we might see. So I'm an optimist on markets, but I'm not quite as optimistic on, I'm an optimist on the economy, not so optimistic on some of the markets. However, it should cause a lot of opportunities for trading and plenty of challenges, but chances to make some good money this year. We're going to go through this. My optimism is we're going to have a 3% plus GDP number for the U.S. We're going to see a little bit of inflation creeping in toward the end of the year. Mainly, there are really two themes here. It's what's not holding us back anymore is as important as some good things that are also happening. And then we'll talk about the market risks. I'm supposed to point this in a certain direction. Oh, go that way. Got it. So the GDP, this will be the first time that we print a 3 number since back in 2004 and 5, if we can do this. A lot of people are getting on this forecast. I wouldn't say it's a consensus yet. There's still quite a few economists, but they're in the 2.5% to 3% range, and they're all moving their numbers up, at least right now. The inflation will be a lot more controversial. This is core inflation. The Federal Reserve looks at core inflation. Whatever the Fed looks at is what I look at. But it does assume that, for instance, that you don't heat your home. You don't eat because they take out food and energy. But those are the volatile components. They don't want a head fake. And what I'm seeing is that by the end of 2014, you're going to start seeing a little bit of inflation pressure, but 2015 should be the year where we really see a lot more coming into the picture. So we'll see how that part goes. Now, the first thing about the outlook that I'm encouraged about is that we're finally out of what I call the deleveraging phase. I mean, we had a bad recession in 2008. But the different sectors of our economy all seem to me 95 to 100% recovered. This is U.S. corporate profits. Obviously, you see the recession. We've come back. Those of you who are really good at noticing graphs will see that this is a slower growth than the original part. We'll come back to that on earnings. But still, we're in fine shape on earnings. Corporations have a lot of cash. They're in good shape. Consumer, this is consumer credit, and the consumer is no longer deleveraging. They went through a period where they really didn't use their credit cards, and now they're back on track a little bit. So they're feeling more comfortable.
Good. All right. So, do you have a drawer on the floor?
This is what consumers buy. We know the housing market has come back a little bit. This is automobiles, and you can see that we really are back in the automobiles. The average age of a car now is like 11 years or something, so there's a lot of pent-up demand. That pent-up demand is not 100% satisfied, but they've made a dent in that, so automobile sales are likely, the growth rate is likely to slow. But they're still likely to have a pretty good year. This is the jobs of the private sector. And if you look at the last recovery and this recovery, there really isn't much difference there. The private sector has done a relatively good job of creating payroll employment coming out of even this deep recession. This is not what you hear from the Fed or many analysts, but to me the private sector has not been the problem. So I think the consumer's in reasonably good shape. I think the corporations are in excellent shape. That's a good thing. We're starting the year financially healthy. Excuse me, I thought that was off. You're going to have to edit that out.
Go ahead and take it.
Okay. Problem getting a new phone. Fiscal, the fiscal state of the union is, we'll hear what President Obama has to say about it tonight, or maybe we won't, but it's in much better shape, in a lot better shape than people realize. But first, the problem child. State and local governments were really important at creating jobs in the early 2000s. These are jobs for federal, state, local, and governments and the post office. The post office plans on losing 100,000 jobs through attrition over the next couple of years. By the way, they employ 600,000 people, so they're going to go down to 500,000. The federal government has not been a big player in hiring or firing, but the state and local governments, this is mostly state and local government hiring, and it's mostly state and local government firing. State and local governments really thought they could get through this recession in 2009. They were hoping for a V-shaped recovery. They thought it would be no problem. And they didn't start cutting jobs until the second half of 2009 when they realized this was really bad. And they kept cutting jobs until March of last year. And then they finally flattened out. And so state and local governments are pretty much in balance now between their expenses and their revenues. They're no longer a drag on the economy. By the way, if you, from the peak to here, that's 850,000 jobs lost in the state and local government sector. If you took those jobs and added them back to the employment data, we'd already be at 6% or less unemployment. Another way to interpret this is that I don't think quantitative easing created one net new job, because I don't think the state and local governments cared about quantitative easing. It didn't help them. So it's a theme here. This is the federal budget. The red line is how much they spend. The blue line is the revenues. The blue line over the last 2 years has really been growing quite rapidly. Revenues to the U.S. federal government were up about 8 or 9% in fiscal year 2013 compared to 2012. And so that was really good revenue growth. That, by the way, suggested that some of the economic data was hiding something. That is, because people don't, when tax payments are up, that means they really are making money. And the tax payments were up very strong. And they're still pretty strong. And you can see the expenditures have flattened out. That's not because of a great plan or anything. That's the sequester and all these arguments and a paralyzed Congress. But the result is that we spent a lot of additional money in 2009. Because in 2008, right at the end of the year, Lehman went bankrupt, AIG had the problems, the Fed stepped in. Actually, it was under Secretary Paulson, under President Bush. They passed $1 trillion spending program. Most of that money got spent in 2009, so that's the uptick in the line, and then it's been flat since then. So if you don't grow your spending and your revenues are growing pretty nicely, we can get back, believe it or not, to almost budget balance. Fiscal year 2014 should be about 3% of GDP is the deficit, of which 2% of which about half of that is interest expense. So by fiscal year 2015, there's a very good chance we'll have a balanced budget on an operating basis. And operating basis means you don't count interest expense. Don't think of it as EBITDA or interest. Earnings before taxes and interest or something, except they collect the taxes. That's really not bad. And that takes, so if the state and local governments are in decent shape and the federal government is getting back to balance, we're talking about a fiscal stability environment we haven't seen in a long time, and that's good news for the economy. The international headwinds are subsiding, even if we had a little disruption and some turmoil in the last couple of weeks. This is Europe. The UK is doing better than the continent. There's a huge housing boom in London. There's some emerging pressures there. The economy has been performing better than the Bank of England's been telling us, so that looks good. The Eurozone is no longer shrinking. It may grow all of 1% this year, but that's better than where it's been. So it's not the problem child it used to be. They have by no means solved their problems or their issues, but again, the worst is over for Europe. So it's a better picture on the European side. On the emerging market side, These are the growth rates over the last couple of years, and they've really slowed down. They've decelerated. And about half of that's China. China's gone from being a 10% growing country to a 7%. You know, they posted numbers of 7.7% GDP growth for 2013. I think 2014 will be more like 6.5 to 7. But they're not going to have a hard landing, but they are still slowing a little bit. Countries like Brazil, Mexico, those countries have really stabilized. They'll probably grow slightly faster in 2014, but off a low base. So they're coming back up, but really it's more like a stability. A lot of the issues in the emerging markets that we see now are political issues. You know, you turn your TV on and there's this demonstrations in the Ukraine, there are demonstrations in Turkey. Last summer there were demonstrations in Brazil. These are interesting because some of these demonstrations come from a different kind of political atmosphere. The first 10 years of this century, we raised a lot of people into the middle class. The middle class has a different expectation of their government. And there's a lot more people in the middle class in these countries than there used to be. So their politics is really changing. And it's more the political risks that are going to drive which emerging market countries we want to invest in and which ones we want to avoid than it is the economic risks. So the economics of the emerging markets have stabilized. The politics have gotten a little bit harder to figure out. Monetary policy. What we have from the Fed, this is, by the way, the holdings of the Federal Reserve of 10-year treasuries are longer. And they've told us they're going to taper off their quantitative easing. They'll give us an update tomorrow afternoon. I, like most other economists, think they're going to continue the tapering effort. I think it was a very hard call for them to start tapering off quantitative easing. But once started, they're going to have to see some really bad data to stop tapering. In my research, when I do my quantitative work, I used to use the size of the Fed as my variable to explain different things. That didn't capture things all that well. And so now I look at their holdings of 10 years or longer. If the Fed buys a T-bill or even a 3 or 4 or 5 year maturity security, it really doesn't impact bond yields very much. If the Fed buys a mortgage-backed security, even though it's got a long maturity, it doesn't. The prices of those things are set off the 10-year anyway, Treasury, and all they're doing when they buy mortgages, they just make Fannie Mae and Freddie Mac's life a little easier. They add a little liquidity to the mortgage market, but they don't change rates. So the only thing that the Fed does that changes long-term yields is what they might be doing buying in these the 10-year or longer sector, and that's going down in 2014. Hopefully we'll see, but they'll be out of it. What really happened in December, though, is the Fed finally told us that they were optimistic about the economy. They've been one of the huge pessimists on the economy. I mean, when they tell you that we have to do quantitative easing, they're basically telling you that this recovery is so fragile, without us it would die. I don't believe that. I think they were wrong, but I do believe that the economy responds to Federal Reserve guidance about the economy. And this is the first time they've been optimistic since 2008 or 2007. So I think that's a real big positive that the Fed is a much more optimistic player here. The futures market in Fed funds, which by the way is arbitraged against the Eurodollar market and everything, so even though it's not the most liquid of markets, it's actually can trade fairly liquid on certain days and things. The futures market on financial Fed funds futures is telling us that we might get a rate increase by September 2015. Now that's the 50 basis point mark, but you can't get to 50 unless you get to 25. And the Fed is keeping the Fed funds rate between around 10, 12, 15 basis points right now. So they would have to tighten up a little bit to push the Fed funds rate toward their upper bound. Currently their guidance is it'll be between 0 and 25 basis points. So we would see first a move to 25, then they will debate forever, or maybe 6 or 7 months, what they want to do about rates, and then finally you would get some kind of the first real increase in the Fed funds rate. But we know from the QE episode, and I think it's probably a parallel, it's going to take 6 or 7 months of debate before the Fed can really make a decision. So if the futures are saying September 2015, we could see that debate affecting bond yields and bond market volatility and equities and equity market volatility from late 2014 into 2015, because markets anticipate these things. So it could happen sooner than this. I do want to talk about the energy boom a little bit, because that's a big positive for the economy. We have about 40% more crude oil production in this country than we had 5 or 6 years ago. That has meant that our oil imports are declining, and we're actually exporting some of the stuff. The effect of natural gas has been a little less obvious. We're also about 40% more production of natural gas in this country compared to, say, 2006. But we consume almost all of that natural gas domestically. So we got all this new production, we've just decided to keep it here and consume it here. But what we've done is we've switched over a lot of power plants from coal to natural gas. So we are now we've doubled our exports of coal in the last 5 years. So we're shipping that off to Europe and China and keeping the natural gas here. And we're importing very little coal now. But by the way, I add about 0.5% to my real GDP forecast for the energy boom. I've been doing that for the last couple of years, and so when I say we're going to have 3.5% this year, if it wasn't for energy, it would be like 3. And last year, when I said we'd have a 2% economy, it would have been 1.5% without energy. And I think we're good for that 0.5% for another 3 to 5 years, and maybe even a little longer. And it's not just that we're buying. It's not just that we're producing more energy, we're building the infrastructure. You're building a pipeline, we're building a fertilizer plant, we're building other, more industrial plants to make use of the cheaper energy. So there's a lot of things, municipalities are buying buses that run on natural gas, trains, they're building train engines that run on natural gas. They're doing all kind of things, and those are where the jobs are all from all the indirect effects. And also a word on Keystone. If President Obama approves the Keystone pipeline, that's good for jobs in the United States, and it's good for the Canadian dollar. If President Obama decides to reject the Keystone pipeline, it's really bad for the Canadian dollar. It doesn't really affect the U.S. very, very much. And the impact is not so much on the oil price. The Canadians are going to produce that oil no matter what. The only question is, how does it get from Alberta to the refineries? It's going to go on a train, or it's going to go through a pipe. And the Canadians are not going to be able to build their own pipeline through the Canadian Rockies all that easily. If they think our politics on the Keystone pipeline are difficult, wait till they meet up with their special interest groups and other indigenous populations in those areas. It's going to be messy. So trains are the way to go. Trains add $10 to $12 per barrel of oil to get it from out of the ground to the refinery. And Canadian oil is a more expensive version of oil coming out of the ground or out of the tar. There are going to be some interesting dynamics in the oil market. But that pipeline decision will, in my view, hit the Canadian dollar more directly than it'll hit the oil price. But we'll see. That decision should come in a couple of months. We'll find out. They've been delaying it, pushing it off, but I don't think it'll be delayed too much longer. Markets. The Fed is still very data dependent, and the most important data the Fed looks at is payrolls, and payrolls are really volatile. This is the monthly change in payrolls. And I still think we're on this 175, 180,000 jobs a month track. But there's a lot of noise in this number. So for me, too much it comes back up, and when it goes up it comes down. That's just, it's a noisy number. Janet Yellen is going to change the way the Fed looks at this number, but that will take about 6 months to a year. She's a labor market specialist. She knows everything there is to know about labor market data. And she will look past this number and want to know all kind of detail that we've never even bothered to look at. I'll give you an example. She likes to look at something called turnover rates. Those are people leave their jobs. Why do they leave their jobs? If they get fired, bad. If they leave voluntarily, that's a good thing in the sense that it shows they had the confidence in the economy to switch jobs. That's the kind of way she's going to take every number apart like that and give it a whole new twist. And by the end of 2014, we'll probably have 10 more charts on the employment situation just because the Fed will be looking at 10 more charts. Figure that out. And I will be doing that too. But I will also be looking at, whoa, that's an interesting thing. The PowerPoint didn't like that. This blacked out segment here is the only period in which the 10-year bond yield has dipped below the rate of inflation. And that occurred in 2012 and early 2013 during the Fed's maturity extension program and the first part of QE3. Once Ben Bernanke started talking about getting rid of QE, the bond yield went up from 1.7 in April to 2.75. Okay, so that's the only period. Let me give you a longer view. This is the view from. PowerPoint didn't like that one either. This is the view from 1962. Okay, there's been only a couple of periods where the 10-year bond yield and the inflation rate have crossed paths. This is 1974-75. That's OPEC. And even though this is core inflation, which takes out food and energy, when energy prices go through the roof, all kind of prices are affected. And that's what happened there. And then you have this period that got blacked out in the other screen. That's the QE period and the maturity extension. Otherwise, you're going to have a decent spread between the core inflation rate and the 10-year yield. The spread looks kind of large here in the 80s coming down. That's because inflation came down much faster than expectations. We were at 13% inflation in 1979-80. And we came down very fast, much faster than people thought possible, and expectations were lagging that, so the bond yields stayed a little higher longer until they were comfortable that we really were at low inflation. Notice that we've been below the 2% inflation mark since 1995. We've been right at 1.5%, 2% for a long time now. Inflation is very hard to start. Once you start it, it's not on this graph, but the whole 50s were below there. Inflation is very hard to start. Once you start it, it's hard to stop. Once you stop it, it's fairly hard to get started again. So, my forecast is that we do see a creeping up of the inflation rate in 2015, but, that's, we'll see how that works out. But that's what the rest of us are going to be looking at in terms of the Federal Reserve, because the Federal Reserve's given 2 points of guidance. You want the unemployment rate below 6.5%. There are going to be a ton of caveats on that, but that's basically going to happen. And then they want the inflation rate to be rising above 2% toward 2.5%, and that's the one that may take a little longer before they raise the Fed funds rate. What this means to me, though, is until I see some inflation, I'm not willing to talk about a great rotation in bonds out of equity, or sell your bonds, buy equities. That to me is early. I think it'll happen eventually, but and we've had some outflow from bonds, bond funds, but I see that stabilizing because there's no inflation, so we've kind of paid the price, and we've got the spread back. This is foreign exchange rates. The blacked out area just shows that it's volatile with no trend. This is the general dollar move. The dollar has had some wonderful trends over the last 50 or 60 years. If you trade foreign exchange, we used to have ties made up. The trend is my friend. We burned them all the last 3 years. But they could come back as soon as interest rates start to move around a little bit. Equities. This is a chart from 1992. We have basically 3 rallies here. We had a tech rally, then we had a housing rally, and then what do you call the most recent rally? Do you want to call it a QE rally, or do you want to call it an earnings expansion recovery rally? It makes a little bit of a difference because I think you're going to lose your QE, and if that's what you were depending on, you're probably already cutting back your equity position. Earnings are a little bit different. If you remember that chart in the beginning, earnings are slowing. growth rate is slowing. So earnings are still growing, but they're not growing as fast as in the first recovery years. My own view is that the stock market price is expecting a higher rate of earnings growth than we're likely to get. So if you want to keep going up on that path, you have to have multiple expansion. And to expand PE ratios, normally that would mean lower interest rates, and I'm not going that place. They might be stable in the bonds, but they're not going down. That makes me very nervous about equity. So I'm an optimist on the economy, but I'm not an optimist on equities. They don't have to go down far, but And by the way, I did update this chart. There's a 3% decline from the peak there, which is about where we are. That's all we've done. Gold. The gold market, you buy gold when you're afraid of a financial disaster. The probability of that has gone down just because the central banks have told us they're going to not let that happen. And I believe them on that. You buy gold when you're afraid of inflation. There's no inflation out there yet. You buy gold if you're in the country of India because they're the first or second largest importer of gold and buyer of gold, but they've added tariffs and raised their tariffs on gold last year 3 times. So they've dampened down some of their demand for gold, and you buy gold. China's the other big buyer of gold, and their economy's slowing down a little bit. So the economics of gold are pretty difficult until we start to see some inflation. As soon as we start to see some inflation, now you have 2 choices. If you think the Fed is going to do nothing and let some of that inflation happen, you want to buy gold. If you think the Fed is going to not do what they've told us, but in fact tighten up a little earlier, then you don't want to buy gold. So we'll kind of tackle that point when we get there, but until we see some inflation, I just see volatility and maybe even a little more downward pressure. Oh, you could get gold mines closing. There's some strikes in South Africa, but there might be some owners of gold mines that don't want to produce. There's a lot of expensive gold out there that is no longer profitable. Hopefully they hedged it out 4 or 5 years. But anyway, if you see gold mining closing, don't worry about it affecting price at all, because there's 99% or something of the gold that was ever mined is still around. And gold supply doesn't impact, or new supply doesn't impact the price in the case of gold. It just impacts the profitability of gold miners. And gold mining stocks tend to be high beta relative to the price of gold. If the price of gold goes down a little, they go down a lot. The price of gold goes up a little, they can go up a lot. Copper and gold are interesting for me. This is the relative price of copper to gold. Copper is much more of a pure industrial economy, so if the world's economy looks a little better and there's no inflation, then there's a slight favor to copper in this thing. So it's a relative price kind of view. Emerging markets, however, where most of that demand has got to come from. So you've got to be a little more optimistic on emerging markets to get really in front of the copper relative to gold. Energy, I always show this chart. This is if I give you $1 and ask you to buy a BTU, if you spin it on natural gas, you get about 200,000 BTUs until the last couple of weeks, and then maybe you get a little less than 200,000, and you get 60 or 70,000 BTUs of oil. That's a huge gap that will eventually get closed by more infrastructure building and price pressures between the two. The big thing here is the only place that oil and natural gas collide in the marketplace is in transportation. Oil is 90% transportation fuel, whereas natural gas generates electric power, does a whole bunch of things, and it's only about a 5% transportation fuel. If it went from 5 to 10, that's bad news for the price of oil and could raise the price of natural gas. So you got to watch, are they really buying more natural gas buses? Are they really buying fleet trucks using natural gas? Are they really converting to engine locomotives using natural gas? If that trend, which has been fairly strong in the last 2 years, continues, it can help drive this gap. And this gap is the inverse of the price gap. So it would be an upward pull on natural gas over the next 3 or 4 years and a downward pull on oil. It's not a short-term trade. This is a 3 to 5 year thing. Corn, Agriculture is the sector that we talk about that has the least relationship to economics at all. It's all about whether it rains in the breadbasket areas. And when it doesn't rain, corn can be way higher, and when you go a long period of time, it can be lower, and this is when the ethanol stuff first came in. I don't think ethanol is going to be a big player in the corn price, but we are seeing the likelihood that some of those mandated things will be cut back a little bit or minimized and not have as much impact. The weather patterns that I look at, I'm by no means a weather forecaster, but I do watch it. I watch, my own favorite thing to watch is the temperatures in the Pacific Ocean. Because at the Pacific Ocean, the northern Pacific, is a little warmer than usual. Warm water evaporates more, the evaporation comes down as precipitation. We'll get rain somewhere, but it kind of matters where the warm spots are. If they're further south, that would help California in their drought if they're a little further north. So it's a little trickier than that, but right now there's still some fairly large pockets of warm water in the Pacific. So the Corn Belt looks okay, so far so good. There are many other factors that affect weather, and certainly rain in these areas. I've studied the volatility of these things, and it doesn't appear that the climate changes that we've seen have increased the probabilities of drought. That is, the zigzag on how much rain we get in the Corn Belt is about the same as it's been for 100 years. What is interesting is we do have a little more average rain in the Midwest than we used to have. Almost about 2 inches more than 50 years ago. So the warming of the oceans has resulted in a little more rain. It hasn't affected Corn Belt temperatures that much, and we still have plenty of volatility in those. And of course, I'm just talking about the U.S. We have a climate event in another big grain-producing region. It can impact this price as well. But right now, it looks relatively benign weather-wise, even if it's cold out there. Anyway, that's my summary of the asset classes. It's an optimistic forecast for the economy. I'm nervous about the price of equities having maybe a discounted higher earnings growth than we're going to get. That suggests more volatility in equity markets. We've seen the VIX go up quite a bit, and we've seen a lot of trading in CME options on equities in the last couple of weeks as that view kind of has moved into the market. On the bond market side, I'm really watching for that first burst of inflation, and to me it's still 6 to 9 to 12 months away. So I think we see more like range trading in the bond market for a while, but there's plenty of economic data and Fed talk to create some volatility there. 2015 could be a hugely volatile year in the interest rate sector if we start getting a debate about the Fed funds rate. Energy to me is about relative prices. Not about a big, no big push for higher oil prices, but a lot of action between coal and natural gas and crude oil. So anyway, that's kind of my summary. Let's, any discussion, questions, we're ready for them. Yes?
Where do you consider real inflation? Obviously, they take out...
I don't have a graph of it here, but if you take a long view, the graph of inflation that includes food and energy is more volatile, but the trends are almost exactly the same. And there's sometimes when core inflation gets a little ahead, and there's sometimes when the food and energy. I mean, the Fed has made this argument that they feel like because the food and energy part is more volatile, that it could give them a wrong signal, and they want to wait to see it get through to the other prices. But you really don't get, on an annual basis, you don't get that much of a different answer. So it doesn't bother me so much that they don't look at it, but it is a luxury of a country like the United States or Europe to be able to do that. If you move into the emerging markets, food is a much, much larger percent of the average person's income. And so when food prices rise in, say, in India or Brazil or China, the politics get nasty really fast. So from a political standpoint, the U.S., being as rich as we are and spending a lower proportion of our income on food, we can kind of ignore that. I can really apologize. I thought I would kill this thing. So you get that problem with that they have to take the politics of inflation, food inflation more seriously, and so their central banks take it more seriously. But it's not that big a deal. You can do the numbers either way. My charts wouldn't look all that different.
Do you think Europe's out of the woods, or are they still having a lot of problems over there?
They're out of the deep part of the forest, but they're still seriously in a lot of trees. The big problem with Europe is no longer their fiscal policies, their sovereign debt, the bond yields have come down, but their banking sector is undercapitalized. There's a huge regulatory debate going on in Europe about how to regulate banks across Europe. And there's a lot of pressure on the ECB, which is going to take over Europe-wide banking monitoring and supervision, to stress test banks, which they're going to do at the end of the year. And there's pressure on them to fail a bank or two to prove the tests are tough. None of that is good for their banking system. And so we will, we'll see how that works. But it's really, you can't grow an economy all that rapidly without a good credit system. And Europe, unlike the United States, depended on it, and when I say Europe, by the way, I don't mean the UK, I mean the continent. The European continent depended on its banks to fund their government deficits. In the United States, we depend on China and the other central banks around the world to fund a large part of our government deficit. That wasn't an option for Europe. They used their banking system. And their banks were more universal banks, and they preferred to get their business clients to borrow money from the bank rather than issuing bonds. So they don't have as well developed a bond market, particularly for smaller companies, not as much of a high yield market. High yield bond issuance has gone through the roof in the last 3 years in Europe to replace banks. So the banks are feeling the competition, they're undercapitalized, they still have some toxic assets on their balance sheet, and so Europe is still in the banking woods, but it's out of the fiscal problem woods.
Thank you.
Yes?
Do you have any take on the housing market for 2014?
I think the U.S. housing market, the bloom comes off just a touch. There was a lot of rebound effect going on. A lot of foreclosures and houses were bought by private equity, which was a very unusual situation. You see these, you can see some data about how many houses were bought for cash. They really weren't bought for cash. They were bought by leveraged money, but they didn't actually take a mortgage out, so it was fund buying and stuff. That will taper off. But on the other side, the supply, most people that wanted to put their house on the market and somewhere in the last 18 months did. And we've cleared out a lot of hidden supply. So I'm looking for growth in house prices, but at a slower rate. And I'm looking for a little bit of growth in home sales, but maybe not quite as much. And housing starts may still go up. In fact, I think it will go up, but again, not quite as fast as the recovery year of 2012 and 2013. So we kind of had, we didn't recover in housing until 2012, its first good year. And 2013 built on that, but I think 2014 we're off the bounce, and but it's still going to be okay. I don't see house prices falling. I still see them rising, just not as much. And all of that falls through. But housing will not be as big a driver. Yes?
Janet Yellen, what's your impression on her taking over? And is she along the same lines as Bernanke, or is she gonna?
She is absolutely not Ben Bernanke. She was a supporter of everything that Ben Bernanke did. But if you read her speeches, at the time when I read her speeches, I really kind of said, oh, well, I was just checking off, she's in that camp. Now I went back and looked at them to try to figure out some of the nuances, and she was actually careful to say, we're doing this quantitative easing as an insurance policy. Her main reason for wanting to do something was the labor market. She was looking not just at the unemployment rate, but the extended unemployment rate, the duration of unemployment, all those kind of things, and she just felt that we were still in a much more fragile situation in the labor markets. So she's going to take us more deeply into labor market issues, and there's going to be a fairly big debate about whether or not the Fed can even do anything about the labor market. The labor force is slowing down. That's because the population growth is slower, labor force growth is slower. So you don't create as many new jobs when you don't have to. The labor force is aging. My tennis game is still very good, but it's not as good as it was 10 years ago. So you have this issue with the labor force actually aging, and then technology has changed the labor force. The new jobs, the new higher paying jobs are what you might call mine jobs, and the lower paying jobs that are getting created are more manual working jobs, and we're getting a bigger income disparity there. But it's not clear that any of those things, the aging of the labor force, the productivity of the labor force, the mine versus manual type jobs, that monetary policy has anything to say about those. So that'll be the kind of things where she drives the research on. So I think that part will be different than Bernanke. Bernanke was a student of the Depression, so the last thing he wanted on his resume was that there was a Depression under his watch, so he was going to do anything and everything to make sure that that wasn't his stamp, and and it's not going to be. Janet Yellen will probably at some point in her term face a little bit of inflation pressure. At least I give it a 60-70% chance, but anyway, if she does, we'll find out if she's really balanced on how she treats inflation. I think she's more balanced than people realize. She's focused on labor because that's her expertise, but also because inflation's below the target. If inflation were at 2.5%, rising toward 3%, I think that she would shift her perceptions more than people realize. So I think she's only a dove because inflation is so low. I don't think she stays that way if inflation goes from 2.5 to 3. I think she becomes as hawkish as because she again, different than Bernanke, she bleeds Federal Reserve blood. She came up through the ranks. She was president of the San Francisco Fed. She's been vice chairman. She is all about the Fed and the culture of the Fed. And the Fed is very much about a dual mandate, inflation and encouraging employment. And so I think, so she's, in many ways, she's one of the most qualified Fed chairmen I've seen. On the other hand, she's going to have one of the toughest tenure. Because she's unwinding all these experiments that have these unintended consequences. Like, if we were to have 3% inflation, we would probably have, I don't know, a 4.5% 10-year bond. That's a $250 billion loss in the Fed's portfolio. Congress might want to have a discussion with her about that. I mean, there's just going to be a lot of issues that the Fed faces that she will have to answer to Congress for. So I think she's going to have a very difficult tenure. Also, she was approved by the Senate by the lowest vote ever for a Fed chairman. Previous to that, Bernanke had that honor for his second appointment. Prior to Bernanke's second term, it was always 90-some-odd votes for the Fed chairman. And then when he came up in 2010 for reappointment, he only got 70 votes, and she only got 56. But there's there's an asterisk by her 56 because there were a lot of Republican senators, about half the Republican senators voted against her, and the other half abstained. Whereas in Bernanke 2010, they actually voted for Bernanke. And then they abstained this time. And I think they abstained because they knew it wouldn't affect the outcome. But in fact, the Fed position has become more political. Her term runs out in 4 years. She's officially sworn in on February 1st, and she has a 4-year appointment as chair. She'll be in her 70s when that 4 years come up, but Volcker, Greenspan, and Bernanke were all appointed by a president of one party and reappointed by a president of a different party. Interesting trend. More than you wanted to know about Janet Yellen. Her husband's a Nobel Prize winner in economics, too. Just God knows what they talk about. Yes. Yes, one last.
Looking at your U.S. economic outlook here, where are the biggest risks? This seems pretty optimistic. Where do you think the biggest risks are?
My biggest risks are in autos and housing. They could be more fragile than we could have bounced off the bottom in autos. Everybody that wanted to buy a car did, and we slowed that down. Housing could be more fragile than I'm giving it credit for, and so we could see a bigger slowdown there. Those are two fairly significant risks. International headwinds, I've been optimistic that the headwinds are dying down, diminishing. That certainly was a view that came under some scrutiny in the last 5 or 6 days. And I am very well aware of the political risks in emerging markets and in China, but I'm still optimistic that that's, this is my forecast, but the politics of emerging markets are pretty important to watch if there's some kind of thing that starts to affect these countries' ability to run their economies. And I mean the big ones, Thailand's interesting, but I'm really talking about Brazil and India and China, Mexico. These are good-sized economies, and if one of them really stumbles, it can take their neighbors down with it and impact even the bigger trading partners. So those are risks. I do not think a failure of a financial institution is a risk to even worry about. One might fail, but the Fed will make. The Fed is not going to do a Lehman Brothers ever again. They understand they made a mistake on that. They handled it badly. That's in their culture now. They don't. They won't do that. Weather is always a risk, but I don't think that's going to cause any problems the next couple of years. They're too much that we can't handle. So there are risks.
Great. Covered a lot of ground there, so I want to thank Blue again. And if Blue's going to stick around, feel free to grab a drink and follow up the discussion after the formal presentation. Thanks.
Thank you.
Thank you.
Thanks.